Take a look at this glowing outdoor stock ticker. Wall Street experienced an intensely split trading session today. The Dow Jones Industrial Average actually managed a positive bump, but that was completely overshadowed by steep drops in both the Nasdaq and the S&P 500. The institution standing behind this building, the Federal Reserve, is the main force pulling the market apart right now. They recently adopted a strategy known as a hawkish hold. Think of a hawkish hold like a parent giving a stern warning. The central bank is pausing any immediate interest rate hikes. They aren't raising your borrowing costs today, but they are explicitly threatening to raise them in the near future to keep inflation under control. That specific threat is incredibly heavy for technology stocks. High-growth tech companies require massive amounts of cheap borrowed money to fund their future development. When the central bank threatens to keep interest rates high, it acts like a heavy tax on their ability to grow. In this diagram, investors react to those threats. They drain massive amounts of capital away from vulnerable tech companies and pour it into safe haven areas like financial banks and utility providers, which benefit from higher interest rates. Large investment firms are moving their funds to avoid these risks. These professional investors are simply packing up and seeking shelter from those high borrowing costs. As we watch this abstract animation of a heavy object rapidly losing altitude, it mirrors exactly what happened to SpaceX today. Breaking away from the broader market, the stock crashed on its own, plunging over 16% on massive trading volume. The first major weight pulling the stock down was an acquisition. Just days after going public, SpaceX announced they're buying an AI platform called Cursor for $60 billion, using entirely company stock instead of cash to pay for it. To see how that hurts everyday investors, watch this animation of a pizza slice. Paying with stock creates something called stock dilution. If a company issues billions in new shares to buy another business, it is exactly like the owner taking a pizza cutter and slicing your single piece into 3 smaller slivers. You now own a piece of a larger company, but your individual portion shrinks. Then came a second shock. SpaceX initiated a surprise $20 billion corporate debt sale. The market panicked because public disclosures show the company already holds over $100 billion in cash. Taking on new corporate debt right after a massive stock offering forces investors to reconsider how fast the company is burning through money. The final layer of pressure comes from the options market, which officially opened for SpaceX last week. Before this, investors could only buy the stock. Now, hedge funds have a tool that allows them to actively short sell the stock, meaning they place aggressive bets that profit only if the price drops. Between the unexpected corporate debt sale, the sudden shareholder dilution, and short sellers pushing the price down, a highly hyped public offering has quickly turned into a stressed environment, driven strictly by financial mechanics. While SpaceX deals with massive downward pressure, specific high-growth tech stocks are ignoring the panic entirely. Companies like Intel and Micron completely outperformed the broader market today. You can evaluate which tech stocks are safe to hold during a rotation by using a strict 3-step framework. Step 1 is checking if the people in charge actually believe in the business. When you check the official records for Intel and Micron, you won't find their top bosses selling any shares. They are keeping their own money locked in, which shows they believe the company is on solid ground. Step 2 is finding companies with a constant stream of guaranteed buyers. Marvell Technology just joined the S&P 500. Because of how most common retirement and savings funds are set up, they are now required to buy and hold billions in Marvell shares. This creates a permanent base of buyers that won't go away. Look at the interior of this sterile semiconductor cleanroom. Step 3 is confirming the presence of a tangible, physical revenue pipeline. Micron produces high-bandwidth memory chips, and those physical chips are completely sold out through late 2026 to power enterprise artificial intelligence systems. Surviving a market rotation means ignoring internet hype. You simply check if the top bosses are holding their stock, if major retirement funds are forced to buy the stock, and if real customers are lined up to buy the physical product. The greatest hidden opportunity created by today's market shift has nothing to do with stocks. Looking at the inscription on the Treasury Department building, the real value lies in government debt. A simple way to trade this is through a financial tool called the TLT ETF. An ETF is just a diversified basket of assets you can buy all at once, and this specific basket tracks long-term government bonds. This balance model shows exactly how the current market treats those bonds. As the heavy weight of the Federal Reserve's interest rate threats pushes down, it mathematically forces the fundamental worth of those bonds, known as their net asset value, into an artificially cheap clearance rack zone. This is where a contrarian strategy comes in. You purchase these artificially cheap bonds right now, while the price is low. You are banking on the economy cooling off and the weight of those threats lifting later this winter. As that pressure lifts, the value of the bond sharply rebounds upward. Now it is your turn. With SpaceX crashing down to $154, what is your game plan? Are you treating this post-IPO flush as a perfect clearance rack entry point, or are you waiting for the short-selling pressure to stabilize? Drop your strategy in the comments below. Market shifts and sudden stock dilution naturally cause panic. But disciplined investors use days like today to watch where the money flows, look for real commitment from management, and pick up incredibly strong assets while they sit entirely unloved on the clearance rack.